in the grand scheme of things, but just like anything in life, knowledge is power.
I'm super excited to be here today with Rodney, CEO at Ion Mortgage and Lending, also the CEO and COO at Ion Property Management. You had 70 properties in the greater Phoenix area.
We found a 12-unit building that was significantly undermanaged, underproducing. We built the property value up. That property is now worth about $4 million. Research is extremely valuable. If I were to be doing research in my teens, I would be much further along.
What are the options available that people maybe are not aware of?
Our most popular loan right now is it's a really, really unique product. It's a new product, and that really opens up a lot of doors for people. But again, if you don't know that it's out there, and you're not going to be able to capitalize on that. Anything over 4 units in multifamily is considered commercial. So you get to that 5-unit number, it's considered commercial. Where I've invested, they don't reach that minimum loan capacity. You're in this gray area.
In that gray area, what have you done? Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality, and where we invite here operators, investors, leaders, and founders in the vacation rental and real estate space so they can tell us about their lessons, their stories, and what they've learned along the way, maybe some of the mistakes they've made along the way as well, so we can avoid making those same mistakes ourselves. I'm super excited to be here today with Rodney. He's the CEO at Ion Mortgage and Lending. He's also the CEO and COO at Ion Property Management. So someone that's very active on the real estate investment side of things, as well as the vacation rental property management side of things, in addition to the mortgage space as well. So we're going to be covering a lot here today, but super excited to have you on, Rodney. Thank you for taking the time. Where are you taking the call from before we get started?
Yeah, Sebastian, thank you for having me on. I'm at my house right now in Newport Beach, Southern California, and excited to be on the show. I appreciate your time.
Love it. Love it. So Rodney, we start before we go into how you built your different businesses and scale those operations. You have been doing this for quite a while, many years. What's something that if you were to start all over again in the real estate and vacation rental, property management space, if you could change anything or tell something to your younger self as far as some piece of advice, what, if anything, would you do differently or advise yourself to do differently if you were starting all over again today?
Yeah, it's a great question. I think when I first think about that question, it leads me to just general research. I was lucky enough to make my first real estate investment about 25 years old, which I think is fairly young in the grand scheme of things. But just like anything in life, knowledge is power. And I was just telling my team this yesterday, our team of loan officers, that the more you know, the more dangerous you become. And if I would have known all the things that I know now, or even a fraction of the things that I know now at a younger age, I probably could have a much more substantial, much more robust real estate portfolio, be much more developed in the real estate game. Not to say that I'm doing poorly, but I think that research is extremely valuable. Knowledge is power, as I said. And if I were to be doing research in my teens, in my early 20s, like I do today and like I continue to do, I would be much further along. And I think that if I was talking to someone that's 18, 15, even 21 or 22, replacing playing things like video games with doing a little bit of research around your future, investing into yourself, it can go a long way. And so obviously that's easier said than done. It does take some discipline, but that's probably what I would say on that, is just getting more knowledge at an earlier age.
Love it. And Rodney, when it comes to learning, there's so many things you could learn. There's so many things you could do research on. It's funny when I talk with people that have made it. A lot of times, they have taught themselves by doing as well. So yes, there's this feeling of, oh, I wish I had learned more earlier, but at the same time, you don't want to be on the extreme of like just learning and not doing anything with all the learning you're consuming. I guess where I'm going with this is, what are the areas that you feel you would have liked to learn more about earlier? Like, what are the areas? What are the the things, the skills? What exactly would you have wanted to start learning more on later, sooner?
I think first of all, financing. I think a lot of people are under the impression that you need 20% down to buy a house. Obviously, in this day and age, with where the house prices are at, the fact that people are making similar salaries to what they were making in the 90s, or maybe just 10 to 15% more, it can be a daunting task to figure out how you're going to come up with a down payment. But a lot of people don't understand that you can buy a house with 5% down. Obviously, you're going to pay PMI, property mortgage insurance. But with that being said, 5% and acquiring the property and paying, $150, $200 a month in PMI is a lot better than renting for the next 15 or 20 years. And so I think financing and understanding your options around how you can acquire properties is extremely valuable. And I think that that's really where I would start. And I think one of the things that you had mentioned is that, you can invest too much time in research. Absolutely. I have some friends that, spent $250,000 on getting an MBA, which I don't, discredit their efforts there or their achievements there, but $250,000 is a down payment on $1 million building. And I think that if you were to take that money and put it into $1 million building, as opposed to putting it into an MBA and having someone tell you how to do it, you may find yourself further ahead down the road. There's going to be a learning curve. There might be some bumps in the road, just like there is with anything, just like there is with any investment. But ultimately, I would choose to invest my money as opposed to going and getting something like an MBA. That's for me personally, but to each his own. And I think that that those are just two quick points that I would make based off your question there.
Love it, love it. And we'll get to, by the way, we'll get to how you scale your property management operation to, at the top you had, 70 properties in the greater Phoenix area. You then downsized, but you have scaled the property management operation. So we'll get to that, because it's what we talk about in this show. But because we're on the topic of lending and we're on the topic of what's possible in terms of down payments, can you shed some light for us on what are the options available at a high level, like one-on-one, financing options available, that people maybe are not aware of? That you mentioned the property mortgage insurance, to be able to put 5% only. Is that something that's only for first-time home buyers? What are the options and prerequisites to qualify for those at a high level? I know this we could talk for an entire hour on this, but just like if you
Of
could,
course.
give a high level first.
Yeah, I mean, first of all, there's a lot of different types of loans. At Ion Mortgage and Lending, I would say in January, February, we probably did about 6 or 7 different types of loans. We did everything from conventional purchases, which would be your 5% down. That would be for a property that you're planning on living in. But our most popular loan right now is what's called a DSCR loan, a debt service coverage ratio loan. That's a really, really unique product. It's a fairly new product as of a couple of years now. And what that product allows you to do is essentially underwrite the property as opposed to the borrower. So essentially, you can look at the rental income from the property, and you can have the bank underwrite the rental income from the property as opposed to being looked at from your W-2s and your income and your financial statements. And that really opens up a lot of doors for people, and is a very valuable product right now. But again, knowledge is power. If you don't know that it's out there, then you're not going to utilize it, and you're not going to be able to capitalize on that. So I would say a DSCR loan right now is something that everybody should be looking into. If you're looking to get into real estate, if you're looking to invest in real estate, if you have a property that you already live in, but want to grow your investment portfolio, a DSCR loan can be a great option for you.
Quick question on that, because sometimes we have people on the show here that have been invested in different asset classes across real estate. And so whenever we have people that come from multifamily and then have gotten into short-term rentals, one of the things they talk a lot about in terms of why they like multifamily as well is precisely the ability to finance yourself based on the property's ability to service the debt. So I guess my question is, what's different in DSCR loans for short-term rentals versus commercial properties, and is this something that are there some prerequisites for you to be able to use DSCR loans for single family, in the context of trying to do an STR investment?
Yeah, I mean, a DSCR loan is, I would say right now, the primary way that people are acquiring short-term rentals, that they're not buying with a conventional loan. They're not, going to the bank and getting creative and saying, oh, I'm going to live in this property part-time, so on and so forth. We do see people try to do that. It's really not supposed to be done like that. We certainly don't allow that, but DSCR loan will allow for you to essentially, like I said, just underwrite the property. And what ends up happening is that you can acquire more properties faster because of this type of loan, because you can have several of them, whereas you can only have one conventional loan because that's your primary property. A DSCR loan, you can have 5, 6, 7, 8, 9, 10 of them. And therefore it's much more scalable. It's much more obtainable. And that's why it's such a popular product right now.
So that means that with a DSCR loan, I get the same benefit from investing in a single family property that I would investing in commercial properties, as in the ability to finance the acquisition based on the assets earnings and not my borrowing capacity. Like there's no difference there between a commercial loan and a DSCR loan that's for single family.
There's going to be some differences. We don't do a lot of commercial lending. I think eventually we'll be doing some commercial lending, and eventually beyond that, we'll probably be doing more and more as we grow as a company. But right now, we're primarily doing residential commercial lending, and the DSCR loan is really what allows you to scale your business quicker if you are an investor in the short-term rental space. I think with commercial properties, there's going to be a lot more checks and balances, a lot more of the bureaucratic process that's going to come into play. And I think that securing that type of financing is going to be a little more difficult than getting a DSCR loan for a short-term rental, because you're going to have much higher property values. The banks are going to be underwriting things much more strict. And you're also going to have less banks that you can go to. There's a lot more residential lenders that are offering DSCR loans, and there are lenders out there that are offering property or that are offering money for a $5 or $10 million industrial building or multifamily building, and those types of processes are going to take significantly longer. I've done a lot of multifamily over the years, and I can tell you that securing the financing for the multifamily space can be more challenging, especially if you're in what I like to call the gray area. Anything over 4 units in multifamily is considered commercial. So once you get to that 5-unit number, it's considered commercial. But what you'll see, like where I'm invested in Arizona, is that a lot of the 5-unit to 12-unit buildings, they don't reach that minimum loan capacity. And so you're kind of in this gray area. You might find an 8-unit building that's $800,000, and you're going to need to get a commercial loan because it's technically a commercial building, but you're not going to be able to really get that commercial loan from a conventional lender because they have their minimum loan requirements. And so therefore you're kind of in this gray area or no man's land, which can also create a less competitive environment. So if you do have access to funding for these types of deals, they can be great deals, but ultimately the financing can be hard to secure.
So in that gray area, what have you done? What's been your approach when you're in that gray area of more than 4 units, but less?
You've got
less
to
than
you've
12?
got to get creative. You've got to get creative, and that's kind of where, if there's a will, there's a way. I remember in 2016, my partner and I, Tyler Barrett, my business partner, we found a 12-unit building that was significantly undermanaged, underproducing. It was in the heart of Phoenix, Arizona. It was listed at the time for $515,000, which today seems crazy for a 12-unit building. The property only had 4 of the units occupied. 8 of the units were unoccupied. 1 of the units had actually fire damage, and the units that were occupied were only being rented out for $450 a month, whereas the market rents on this type of unit was about $750. So if you remember what I said previously, a $515,000 property acquisition price with let's say a 20% down payment, that's going to put you at needing whatever, a $375,000, $380,000 loan amount. And that's just going to be impossible to find from a commercial lender. They're not doing all of that work and all of that transaction cost for a $380,000 loan amount. So what we had to do, we basically got on the phone with the seller. It was very unconventional. We spent about an hour explaining our position. We were very young at the time, I think in our late 20s. And we just made it very, very clear that we really, really wanted to get this property, and anything that they could do to assist us. We talked to them about owner financing. They weren't willing to do a owner carry. at that time. But what they did do was they introduced us to someone that had basically a 1031 exchange kind of tax appetite. He became a part owner in the property. We acquired it with his 1031 exchange tax appetite. We paid him a interest-only loan for a couple of years. We built the property value up, got the units renovated, got them filled, got all the rents up to $800. That then in turn increases the property value from 515,000 to, let's say, 900,000 or $1 million. And then you start getting into that area where you might be able to secure some more kind of conventional financing, and therefore it's a little bit easier. That property is now worth about $4 million. And so it was a great move, and it's a testament to, putting the effort into the deals that you truly believe in, and making sure that you acquire the properties that come across that you feel like are, can't miss deals.
Love it. What a great story. Thanks for sharing that, by the way. And talking about what you just said there in terms of how you increased rent and then managed to increase the value of the property because of that increase in rent, that increase in net operating income. That's one of the things we also talk a lot about here in the show, which is the differences between um, adding value and forcing the appreciation on a commercial multifamily type property versus residential single family for the purposes of short-term rentals, right? So I guess, tell me, what's your opinion on how you look at your portfolio diversification from those two point of views, right? You have more cash flow most of the times on the SDR, short-term rental side. You have the ability to do forced appreciation on the multifamily side. Why would you do more of one or the other? How have you thought of this? And I'm asking because I have people here that are aware of both, but I have people here that are like, oh, I don't even consider the forced appreciation, I just care about cash flow. And then there's people that are like, no, if there's not an opportunity for me to add value in a property, uh, for in a way that I'll know it's going to increase its valuation, even if it cash flows, it's just not giving me the growth I'm looking for and the returns I'm looking for. How do you see those two play together in a investment strategy and portfolio diversification for you specifically?
Yeah, it's a really good question, and it's a question that I'm very passionate about my response on. And what I would say on that is that, I think that for me personally, multifamily is a much more attractive investment. What I've found is that short-term rentals, obviously you have the cash flow, but you also have a lot of operating expenses. You also need to hire a manager or manage yourself, which time is money in every sense of the word. And I think that with multifamily, you are diversified. And so let's say you have an 8-unit building. Let's say one of them goes vacant. You still have 7 other tenants that are paying their rent and helping you to pay your mortgage. The value add play for me is really where our bread and butter is at. What we look for is we look for two things. We look for properties that are basically mismanaged, and we look for properties that are basically dilapidated in one way or another, really from the outside. Lipstick on the pig is a great term in real estate. It's not the best term, but at the end of the day, it is a true kind of way to really make some money and add equity to the property. And so if you find a property that's mismanaged, going back to that 12-unit building that I explained, that it only had 4 of the 12 units that were occupied, 8 of the units were unoccupied, 1 of the units was burned down. There was a lot of riffraff around the community that needed to be cleaned up, and the rents that were being taken in of those 4 units was only $450. So if you look at 12-month cycle of going through, you clean up the trash around the community, you paint the exterior of the building, you repave the parking lot, you get those other 8 units filled up at $750 to $800 of rent. You get those other $450 units up to market rents. Maybe some of them move out and you get new tenants in there. But ultimately, between improving the exterior of the building, it also justifies the rent increases for the people that did have a rent increase by improving the exterior of the building, but also increasing the rents and getting the monthly revenue and the rent roll up to a market standard. Now the building is significantly more valuable. Then you can pull money out of equity, go rinse and repeat. with the short-term rental game, I think a lot of people, especially new time investors, they really want cash flow, cash flow, cash flow, cash flow. That's their main goal. But what we've found in the last 11 years that we've been doing this on both ends, we have about 10 short-term rentals in the portfolio, and we have about 65 to 70 multifamily units in the portfolio. What we've found is that the
That's what you own,
appreciation.
right? That's what you own.
That's
That's
yeah,
excluding what you manage, because you manage more than that
yeah,
on
yeah.
the
That's what we
DSCR
yeah.
side. Right. Okay.
And what we found is that the appreciation on the buildings significantly trumps the cash flow that you're going to be making on a monthly or yearly basis. And that's historic over the last 10 or 11 years that we've been in it. If you look at real estate historically over the past 100 years, and you could really pretty much look at this in any market, it kind of goes like this: goes down a little bit, goes up a little bit, goes down just a little bit, goes up way more. And it's kind of just this steady increase over time. It's a fact. There's a ton of charts and graphs to show this. And so a lot of people, as I said, that are amateur or new real estate investors, they're really worried about cash flow. But what they're not looking at is they're not looking at the tax benefits. They're not looking at the appreciation of the asset over time. And that's really where you're going to make your money. So you might make $2,000-$3,000, maybe $5,000 or $10,000 in a good month, depending on the property. But that property might be appreciating at $15,000 a month for that year in terms of the property value as it pertains to the market. And so we don't really necessarily value cash flow as much as we once did. Obviously, eventually, once you restructure the deal, you get yourself into a better loan, time goes on, the rents increase, that property value, the property acquisition price stays the same, and therefore you have this bigger delta between what you owe on a monthly basis and what you're bringing in on a monthly basis. Then the cash flow can become a little more exciting. But we've never made a ton of money on cash flow. We've made all of our money on appreciation, and that's really kind of the name of the game for us. And so that's what I would say on that.
That's so interesting. And again, this debate, if we want to call it like that, between focusing on cash flow and focusing on appreciation, is also something I'm super passionate about trying to understand more and more here. Now, the interesting thing is, you say this coming from, as you said, having seen both sides, and also, so on the property management side, you now manage a lot of vacation rental properties, as well. So, what would it take for there to be an investment that you can, where you can have the best of both worlds, right? Is there such a thing? Can you look at, I don't know, multi-unit, and then just have a hybrid, and then can that work for the financing piece? Because I guess the challenge then becomes, even if it's a commercial type property, right? You're looking at more than 4 units, um, but it's short-term rentals. Then will the bank look at it the same way? Or the financial the institution financing the deal look at it the same way? Probably not, right? So, hypothetically speaking, if we were trying to think, okay, what does it take to get the best of both worlds? What does it take to get both the appreciation of multifamily as well as the cash flow for short-term rentals? What would you be looking for?
Yeah, I think it's an interesting question, and my answer might surprise you. But the market that I am heavily invested in, heavily knowledgeable on, is the Arizona market. We are heavily invested in Arizona, specifically in Phoenix, Tucson, and Scottsdale. And one of the things that I'll speak on is specific to that market. And as it pertains to the short-term rental space, one of the main things that the Arizona market, specifically Phoenix and Scottsdale, is lacking right now is regulations. And what I mean by that is the regulations are far behind more developed areas like the beach cities, for example, or areas where people have been vacationing for the last 50 or 100 years. For instance, where I live here in Newport Beach, or you go to Laguna Beach, they haven't issued a short-term rental permit since 2016 in Newport Beach. So almost 10 years. So you can't get one if you tried. Whereas in Phoenix, we had the Super Bowl and we had the Waste Management Open a few years ago on the same weekend. We had a ton of people who were expecting to make a massive amount of money. But the problem is there's no barriers to entry in the Phoenix market. You don't need a permit to put your property up on Airbnb and VRBO. So we had about 10,000 people that put their properties up overnight, properties that they live in overnight, completely flooding the market, a market that's already oversaturated. And therefore, we actually had vacancies on that weekend. We had about 750,000 people that came to town, and we still had vacancies on that weekend. And that's usually a weekend where you're supposed to be able to sell the nightly rate at a 10, 15x from what your standard rate is just prior the week before. And so the short-term rental space, specifically in Arizona, needs to tighten up the regulations in order to protect the community, but also protect the investors, keep the quality managers, quality operators operating, and keep the people that are fly by night out of the game. And that'll really, really shore up what it means as an investment, because if the guy next to you is a short-term rental, the guy next to you on this side is a short-term rental, and the guy that you share a backyard with is a short-term rental, it makes it really, really hard to compete with that type of oversaturation. And that's really one of the main things that we need to see in the short-term rental markets, probably across the country, but specifically in Arizona, Scottsdale, and Phoenix.
Hmm. Okay, so you'd be looking for a market where there's some level of regulation in place that's evolved enough so that there are rules of the game that you can follow, and that also limits the oversaturation on the supply side of things, making it more fair in a way. I guess, yeah, it's a double-edged sword, right? Because lower barriers of entry can sound attractive to some investors that are overwhelmed with the overregulation, of some other places. But it does create that oversaturation that you're saying. What else? What else are you looking for? Like right now, today, let's say, in your investment fund, um, you have both. You have seen both. You have seen multifamily. You have seen short-term rentals. You actively manage a large portfolio of short-term rentals. Are you looking for acquisitions that try to mix them in some way, or for you it's just like it's not even worth trying to add the cash flow component of short-term rentals into a multifamily deal because the appreciation is so good, to your earlier point, versus the cash flow that like why bother try to combine both asset classes?
Yeah, I think the challenge with combining both asset classes, for instance, let's say that you have a 40 unit building in Phoenix and you make it into a mini hotel filled with short term rentals. We actually had a company in Phoenix that has since come and gone. They had a ton of these types of buildings and they didn't make it. And part of the problem is that operating something like that, the bang isn't worth the buck. And what I mean by that is, let's say you have a bunch of 1 bedroom, 1 bathroom units and you're operating them like short-term rentals. It's just very, very challenging to justify the cost of operation for what you're getting on a nightly rate. So you might be getting 40, 50, $60 a night, but you have to have, either an on-site operator or you have to have somebody that's going to be going out to the property every single day. And those types of hotels have a lobby for a reason, because the lobby and the front desk is really the heartbeat of the hotel. They're what's going to be able to send you maintenance or whatever it is that you might need. Whereas if you are operating like an Airbnb, you're operating a 40 unit building in the way that we operate short-term rentals, it's going to be kind of clunky and it's going to be a lot more challenging. And that's what we saw one of our competitors feel in Arizona, was that they really grew very, very fast with this type of model, thousands of units. And ultimately, all of their units were becoming dilapidated. They were having a lot of challenges because you're basically running a very distributed hotel chain where you might have, 50 different 40 unit buildings across a major metropolitan city like Phoenix that can take an hour and a half to drive across. You're going to have to either have on-site maintenance at every building, or you're going to have to be sending people across the city back and forth to fix something like a shower head or a doorknob or whatever it is. And that becomes extremely costly and really, really challenging. And so that's one of the things that it would be a turnoff for me about operating a multifamily building as a short-term rental type of venture.
Interesting. Now, despite the oversaturation, there are winners and losers, right? What have you seen the winners within the portfolio that you manage of short-term rentals? What do you see them having in common, versus the losers, as far as the owners of the properties that are doing well versus the owners of the properties that you manage that are not doing as well?
Yeah, I did sales for On Property Management for a long time. I've probably had 1,000 plus conversations around these types of topics. And I always ask people, what are your goals with the property? Are your goals to have a property that you purely make money off of? Or are your goals to have a property that you make some money off of, but you can also have your friends come into for town and you can wine and dine people, have something shiny and nice to point at, have a, quote unquote vacation home, etc. And they're two completely different types of ventures. What I mean by that is for instance, Scottsdale, Arizona is probably one of the most oversaturated short-term rental markets in the country, if not in the world. It's truly an area where you might be on a street and you might have 10 different short-term rentals within eyesight. And that is a problem of oversaturation. And so, but it is also the premier area of Arizona, where you get a snowbird from Canada, or you get someone from Seattle, Washington, who they deal with these, or Minnesota, and they deal with these long winters, and they have very, very cold weather for long stretches, and they just want to be able to go to Arizona, take their family down there, take their friends down there. And again, is your goal to have a house in Scottsdale, or is your goal to have a cash flow positive short-term rental? And if it can't be both, because if you do want to buy a house in Scottsdale, it's probably going to be, it's going to be an okay investment. We do have these one-off properties that do very, very well. But ultimately, if you want to have a property that's going to cash flow more, you might be better off buying it in an area that's not necessarily a premier area, where maybe you could be, quote unquote, the only show in town. I oftentimes steer people towards West Phoenix, the Glendale, Peoria area, because there's a significant less amount of saturation in this market than what there is in Scottsdale. And there's still demand in that area because we have things like spring training. They're putting a huge water park out there. That's where the Arizona Cardinals Stadium is at. And in Scottsdale, that's really the shiny, you have this shiny investment, you have this beautiful home, but also from a short-term rental cash flow standpoint, it's going to be very hard to compete with the other 10 homes on the street. And so that's really what I would say in terms of that, is just, you need to really understand what your goals are with the property, and you need to be willing to really kind of make up your mind one way or the other. And sometimes you can't have your cake and eat it too. For the one-off properties that I did mention, I would say that they have, they have a lot of curb appeal. They have a lot of amenities. Always in Arizona, do they have a pool and a hot tub? Because, we do get extreme temperatures, high temperatures, as well as low temperatures in the wintertime. So those types of amenities can really make a place do well. And then also your general location within the city. Even in Scottsdale, there's going to be areas that are more saturated than others. Old Town Scottsdale is really where the heart of everything is at. The bachelor parties, bachelorette parties. That's where a lot of the people come, spring training, etc. The further north in Scottsdale, you get a little more exclusive. You also get a little more high value on the homes. So you're getting maybe a different demographic of renter and tenant in that case. And so there's a lot of variables and a lot of dynamics that go into to making the decision. Both internal characteristics as well as external characteristics that are going to influence the decision of the investor in this case.
Love it. Thanks for sharing that. Now, let's talk a little bit about downsizing property management operation in the short-term rental side of things, because I think that this is important. It can sound negative. I think it is not negative to look at an operation and say, let's consider focusing on and doubling down on the owners that are giving us the flexibility, number one, and availability, number two, and are investing as well in the property to put it to the level that it's needed to perform. And let's stop focusing on those that are not giving us the pricing flexibility, are not giving us the calendar availability, and are not investing in whatever we're telling them to invest. So because otherwise growth is fun and everything, but if you grow at all costs and you accept any kind of owners, then what's really the point, right? You're not running a tight, profitable operation. So what did you learn in that process, perhaps, of thinking about downsizing on your end?
Man, we learned so many lessons the hard way over the years with different types of owners. In this space, you meet a lot of different types of people. the one common denominator of these people is that they all pretty much in one way or another, they have some form of money, and you're going to get varying degrees of that. But in order to have a short-term rental, typically you already live in a house somewhere else that you probably own. And this is a second house or a third or fourth or fifth house that you own. So these are smart people. These are prideful people. These are educated people. And so, but they also have never walked in your shoes. And so if they've never managed on their own, then they don't really understand what goes into it. And so for us, we've had to really be very, we've had to mature a lot in how we look at things. When we first started and we were really aggressive, we'd say, okay, yeah, you've got a condo with a homeowners association. We'll take it on and we'll deal with that at a later date. Now we don't do condos. We don't do homeowners associations. It's just asking for issues. On top of that, we've had owners that they want to be very involved. And that really gets old, because for us, we need to have full control. We need to have the ability to do things our way. That's why we really truly are the professionals. And the more involved that an owner wants to be, the less attractive it is for us as a deal. We've had homeowners before that sit there and they watch their Ring camera all day long. They watch their Ring camera. They watch the tenants come in and out. They watch and they'll call us and they'll say, "Hey, I don't like the way this guy looks," or even worse things than that. And it's like, hey man, we're not a discriminatory company. We're not going to be starting to accept and qualify guests based off the way they look. It's not the way that we do business. And quite frankly, the call that you're making to me is completely inappropriate. And those types of things, they chip away at you over time, and you really just get tired of it. And you're willing to basically say, hey, we don't want your house anymore. We don't want to do business with you anymore. No harm, no foul. But you're going to have to go your own separate way. We've also had situations in the past. I remember one time in Chandler, Arizona, we had a beautiful opportunity, or an opportunity to manage a beautiful home. It was probably about a $1.5 million home. It was on a lake, and the homeowners seemed to be pretty normal people. There was also a guest house that was associated with the property that they had a long-term tenant in, and we knew that was a little bit of a red flag, but we took it on anyways because we were trying to grow. We were trying to be aggressive, and little did we know they had signed a separate lease with this tenant that he could basically use the backyard at his peril, and he also could park his car in the driveway. Well, we get our first guest, and there's a random guy in the backyard, and there's a random car in the driveway, and it's 4 college-age girls, and it's just a huge problem. And this guy was not a nice guy. He was not an easy guy to work with. He was, and ultimately, he did have a lease that said that he could utilize the backyard, park his car in the driveway, and it was just nothing but a problem. And the homeowners were very negligent. They were very irresponsible. They were very, very rude, quite frankly. And that one was just more trouble than it was worth. Looking back on it, I wish we would have never taken it on. And over time, we've had several deals like that. Every homeowner has a different personality. Some people you never hear from. Some people you hear from every single day. And so it is a very challenging industry. A lot of people get burnt out. A lot of the customers that we do get in the short-term rental space, they're coming to us because they have burnout from self-managing. Managing a short-term rental is a 24/7, 365 type of operation. As I said, I've probably done over 1,000 sales calls. And one of the scenarios that I always tell people is, listen, whether or not you have a daughter, I'm going to give you an example. Let's say you're at your daughter's wedding, and your daughter's, getting married right now, and you've got 10 people that are staying at your house in Scottsdale, and it's 110 degrees outside, and your HVAC shuts off, and you wait 2 hours to get back to them. That's going to be the difference between a guest that's extremely irritated and leaves you a terrible review, which can ultimately put your listing down to be a sinking ship. Or let's say you get back to them in 3 minutes, and you get an HVAC guy out there in 45 minutes to an hour and a half, your go-to HVAC guy, that when you say jump, he says how high. That's going to be a totally different guest experience. That's going to lead to a totally different investment and a totally different business venture for you over time. Because if that's how you are managing, where you're making people wait an hour, 2 hours, whatever it is to get back to them, and some issues are bigger than others, but those reviews are going to stack up, and eventually your nightly price is going to decline because people are going to see that. And eventually you're going to be sweating bullets on whether or not you can pay your mortgage because you weren't servicing this property and you weren't managing this property to the best of your ability. And you're trying to pinch pennies on the management side of things. Whereas we've got 24/7 support waiting by the phone, waiting for these types of issues. We've got the vendors that we have scale with, we have leverage with, and therefore we do get them out there quickly. And so it's a totally different ballgame. And that type of scenario that I gave, while it sounds drastic, that stuff absolutely happens. It absolutely happens. It's happened to me when I was, before we established our company and I was managing short-term rentals just for myself. I've been in those types of situations. It's extremely uncomfortable. Some people care more than others, but ultimately it's not a good situation to be in the immediate term as well as in the long term, because those types of reviews stack up. Airbnb always supports the guest. 60% of our reservations are done on Airbnb. They are the leading provider in the space. And with that said, if you start stacking up those bad reviews, you're going to be in a bad spot, and that's just a fact. So
that's so true, and I see this also being a challenge with investors that come from the long term rental side of things, because if you get a tenant on a long term rental property of yours saying that there's a problem of any kind, and you go the next morning, they're gonna be stoned. They're gonna be super happy. They're like, "Oh, you came the next morning, great." If you stay 2 hours, for a short-term rental guest, that's already too long. So it does take a shift in mindset. And you talked about burnout that can come from the 24/7 nature of this business. And I'm curious to know, how do you manage the fact that you have, basically different companies? Like, you've got the mortgage company, you've got the property management operation, you've got the real estate investment business. How do you manage your time, and how did you get it to a point where, I mean, you didn't burn out? I mean, I'm sure there's enough things to do only in your mortgage business. So how have you avoided burnout?
yeah, it's a really good question. And it's, we've been lucky. We learned early on, there was a lot of stress and a lot of days and nights where I was wondering, what am I doing here? Because it became overwhelming. The stress early on, I would say back in 2019, 2020, when we were originally building Ion Property Management. And I think that you learn along the way as you mature as an entrepreneur, as a business owner, that people are incredibly important, and getting the right people on the bus is incredibly important, and getting the wrong people off the bus is incredibly important. That's a Nick Saban line, the old University of Alabama coach. I've watched a lot of his speeches, and he says that all the time. And it really resonates with me, because he says that my job is to get the right people on the bus and the wrong people off the bus, because high achievers don't like mediocre people, and mediocre people don't like high achievers. And one of the best things that we have done as a company and as multiple companies is that we've gotten the right people on the bus and we've gotten the wrong people off the bus. And I'm not going to talk about people from the past, but what I will say is that specifically with Ion Property Management and Ion Mortgage and Lending, in the last year and a half, we have great day-to-day operators, a general manager for Ion Property Management, and Hans Schmidt, who came over to us from a company that had 168 short-term rentals. So he's very, very well versed in managing a short-term rental portfolio, and he does the job in a great way. And he has been a great breakthrough for Ion Property Management. And then at Ion Mortgage and Lending, we have a VP of Operations, Cody Rao. And those two gentlemen, they handled the hour by hour, day by day initiatives of the business. And myself and my business partner, Tyler Barrett, we basically pull the strings at the top. We have a few calls per week that are, hour and a half type calls with those guys. And we really kind of guide and steer the ship from a 50,000 foot view. But they're really the ones that are in the trenches on a day-to-day basis, and allowing us to continue to go out, do things like this, grow the business, and continue to grow our entrepreneurial footprint, which is really our goal.
And if we can talk a little bit about lessons there, in terms of, um, what did you learn as far as the red flags for avoiding the wrong people, maybe the red flags for when to know it's time to let someone off the bus, and also what you're looking for now, when you're looking for people to hop on the bus.
It's a really, really good question. I think that what I would say to that is that when you recognize that they're not the right person, cut it off. Because typically what happens is that, and I can tell you this from back when I was an employee in the solar industry, I always worked really hard. But I can tell you that those first couple months on the job, you're given your A plus game. and then it kind of tapers off from there. You get to be a year and a half, 2 years in. Maybe you go to the gym during the day, or you take off work at 3:30 or 4:45 or whatever, and you're not putting in a full day. You're still getting your stuff done, but you're not working as hard as you were in that first couple months. And I think that if someone is showing signs of being weak or non-committed or shady or whatever it is, in the first month, 2 months, 3 months, you're better off to just move on, cut your losses, and figure out and give the next person a try. And also to take the time to really go into the process, invest into the process, whether that's your time, whether that's your money, hiring a hiring agency. Hans Schmidt, our general manager for Ion Property Management, we found him through Better Talent, which we hired Better Talent, which is a short-term rental specific recruiting agency. And Hans came to us via them, and that was not a cheap service, but ultimately for what Hans has provided for our company, the guidance and the autonomy that it's provided for myself and Tyler as business owners, it's invaluable. And so I would say that making sure that you don't just hire the first person that does a great interview, and that you really take the time to invest both the time and the money into the process. And then also, like I said, if they don't turn out to be the right person, making sure that you cut your losses early on. Don't let them dig a hole in your company and set you back because you weren't willing to make a move and move on.
This is so true, and I like a couple of sayings that are related to people, operations, and recruitment and HR. One of them is hiring is guessing, firing is knowing. So I think it goes to your point on, like, at some, as much as you can do a great job at the hiring and recruitment process, you will see the signs only once they start working. So, you know, hiring is guessing, firing is knowing. Also, of course, you've heard, hire slow, fire fast, which goes to what you're suggesting as well. The moment you spot those red flags, and then there's one also when I was involved in the recruitment process for Angel Host over a few years. I was leading that department, and I saw potential in so many people, and then it was making the decision making harder. And I just said, you know what, let's simplify this. Is it a hell yes or no? Like, if it's not a hell yes, it's a no. And that way it was also easy to spot talent. Because, and I don't know where I've heard this, but I've heard this somewhere of, like, you're never gonna have someone that doesn't come across to you as a superstar in the interview process become a superstar afterwards. So, it's just not going to happen. Like, you can see when someone is a superstar, and if you're having doubts, most likely they're not. So just move on before it's too late,
Yeah.
type of thing.
Yeah, we had a girl a few years back. We hired straight out of college. She worked for us part-time for about 3 months. She did a good enough job for us to offer her, as we were growing rapidly at IM Property Management. We offered her a full-time job. We bought her a MacBook Pro. It was her first Monday of her full-time employment with us. And I kind of found a little reason to give her a call, just kind of test the water. It was about a 10:30 or 11 a.m. call on a Monday morning. And I called her on Slack, which is our communication channel that we use. And she answers the phone after about 5 or 6 rings. And I say, "Hey, what's going on with the onboarding of 68th place or whatever, for example?" And she says, "Well, let me go downstairs and open my computer, turn on my computer and check it out." I'm like, I own the company, and this is your first day on the job. Your computer should be open, turned on, and you should be engaged in work at 11 a.m. on a Monday of your first day of full employment. And it just showed how disconnected, specifically the younger generation can be, because to say that to me in that instance, I thought was pretty bold, but also fairly clueless in that regard. And she's no longer with us, but ultimately, we did keep her on the team for probably longer than we needed to. And she's a good person, a good girl, but ultimately wasn't the right person for us at the time. Probably had to mature a little bit more in her career. And that was the first day of her full-time employment with us. And quite frankly, I should have noticed earlier on. But I'm a more mature business owner now than I was 5 years ago. And you live and you learn, as you said.
Yeah, no, definitely. And I think there's also an added challenge to dealing with employees remotely. Nowadays, VAs, virtual assistants, it's become this thing that everyone talks about, how they work with VAs and VAs and VAs. And they don't realize that at the end of the day, it's like working with an employee. It's just that they're virtual. Like, you need to set the expectations. You need to be present. You need to set deadlines. You need to, have performance reviews. You need, like, otherwise you'll have a situation where it's 11 a.m. in the morning and they haven't opened their computer, right? So yeah, it's
What we found with the VAs is that, just like you said, I mean, there's good VAs and there's bad VAs. We've been ghosted by VAs on the job. They just didn't show up, never answer again. We had another VA that was taking a ton of bathroom breaks. I mean, every 15 minutes he was quote unquote in the bathroom, and was just unable to respond to the guest messages and things like that. So, it's just like anything. They can be great, they can be bad, but ultimately, if you can find good ones, I'm in full support of it.
Yeah, for sure. Perfect. Now let's talk a little bit about the your future outlook for this industry, as well as, on the investment side, as well as on the property management side. So where you're at now, when you look ahead, what's the main opportunity that you see, and what's the main threat that you see as well?
The main opportunity, let's see. I mean, for us, we really want to continue to push the envelope in terms of asset classes that we're invested in. We would really like to try to get into industrial, commercial here in the next year or two. Through the research that we've done and the conversations that we've had, we feel like you can really have some kind of just really, really stabilized investments and assets in that class. Obviously, the reason that you don't start with something like that is that the acquisition price for those types of assets is going to be significantly higher than buying something like a short-term rental. But with the industrial commercial side of things, you're going to have an anchor tenant. They're typically going to sign about a 5-year lease. That lease is going to have about a 5% escalator or somewhere around that on a yearly basis. And that anchor tenant is going to probably pay about 70-80% of your rent in that case, and therefore you're going to basically be in a good kind of stabilized position. And so that's really something that we want to kind of try to venture into here over the next couple of years. We're also looking to potentially kind of get rid of some of our short-term rentals that we have in our personal portfolio, because of some of the issues that I talked about with the saturation. Also, in the Phoenix market, it is very seasonal, so those summers get to be very long. From basically like June on to really kind of the start of October. You're really just trying to get by, and it's very, very challenging with the numbers. But then once October comes around through May, you're really kind of booming, and so it is very, very seasonal. And really for us, I mean, we've done a lot of it, and I think that we want to continue to grow our management portfolio, but ultimately we'd like to divest from the short-term rental space and really kind of consolidate those 7 to 10 short-term rentals that we do have, and really maybe consolidate that into one industrial building that's just easier to manage and a more stabilized long-term asset. And in terms of the risks, I mean, obviously the rates are high right now, which really kind of puts a glut into the industry. There are still a lot of deals getting done. We're doing about 20 loans a month at Ion Mortgage and Lending currently. And a lot of those are cash out refis or DSCR loans, as I talked about, people that are going and making investment moves. But I think obviously if the rates don't come down, then we're going to continue to see, a slower real estate market, for the foreseeable future. But hopefully if the rates do come down, even if they come down 1% and you can start getting mortgages back in the fives, I think that we're going to see a lot of buyers into the market, and you'll start seeing a lot of activity both on the buy and potentially on the sell side, because that's going to lead to property values increasing if the rates do come down. So you might see some activity, and hopefully toward the end of this year or even earlier, we start to see some activity like that. But if the rates don't come down, we're going to continue to be in a slow time in real estate.
And who's doing cash out refinances at this, these days?
Really experienced investors that can make the numbers pencil, developers, people like that. We also have people that just have debt that they're looking to rid themselves of. 20. Let's say you have 22% credit card debt, 24% credit card debt. You can do a cash out refi at 8 or 9%, and that's a significantly better deal than paying 24% on credit card debt. So it just really depends. Obviously, it is a very unique situation for someone to be pulling out a deal right now. There's also people that believe that the rates are coming down, and they're in the mindset of date the rate, marry the home kind of thing. And so that's a common mortgage saying there. And obviously, if you can get into a property right now, and let's say you do have a 7.5 or 8% interest rate, obviously that's not ideal. But if the rates do come down, let's say another half or a 0.5% or a full percent, they say that every 0.5% that, or every 1/4% that the rates come down, I believe they say 5 million buyers enter the market in the United States. And so it's obviously just a kind of a sliding scale where the rates come down and the prices go up and the deals get more competitive. And so if the rates go back down, we all remember 2020 when the rates were at 2.75%, and you would make an offer on a home and there would be 35 offers on that house and you wouldn't even hear back from the real estate agent. That's really kind of an unhealthy environment to be in. We were actually doing a 1031 exchange during that time, and we were on a time sensitive clock looking to acquire some properties, and we're just making offers left and right on different short-term rentals in the Phoenix market. And even getting in a conversation with the agent at that time was very, very difficult. I think a nice area for the rates to be at is in that 4.5, 5% area where a house is on the market and maybe it's fairly priced. And in the first 30 days, maybe you get 2 or 3 offers and you can have some negotiations with those 2 or 3 different potential buyers. But having 25, 30, 35 offers on the same house, it's unnecessary. It's unhealthy. It's a big waste of time. And as I said before, time is money. And so that's kind of what I would say on that.
And when it comes to rates being where they are at now, what's your take on? I've heard some people say that despite rates being, still high, that the prices of real estate haven't yet adjusted as much. Sellers haven't yet started to lower those asking prices. Would you agree with that, or what are you seeing in the Arizona market particularly?
Yeah, I think that's fairly true. I mean, people only have one, so much equity depending on when they bought, but two, a lot of people are not in a rush to sell unless you're basically, one of these young families that, in the last 3 years, since the rates have been extremely high, maybe you've had 1 or 2 kids, and let's say you're living in a 2-bedroom apartment that you had before you had any kids, and now you have 2 kids and you're really under some stress. I actually just talked to a borrower yesterday who was in that exact situation. They're going to be having a kid here soon. It'll be their second kid, and they're looking to basically, go and get a mortgage on a $1.3 million home so that they can get their house, so that they can have more space for their eventual family of 4. But I think that, if I was a seller right now, and I'm not a seller right now because the rates are so high, once the rates go down, and it can happen at any minute because we have been in this, 2.5 year time where the rates have been astronomically high and historically high for whatever the last 30 years or so. Once the rates do go down, the property values are going to increase. So you have a lot of people who don't want to give their property away, so to speak, just to meet the buyer in the middle. And they're willing to kind of ride it out and see. But there is a decent amount of inventory in Phoenix right now. There's not a lot of houses moving, and I think that the houses that are moving are the more kind of luxury homes where the people just have so much money that it doesn't really matter to them what they're paying or what the interest rate is. And but when you get into that more common home, $500,000, $700,000 house, those houses can be sitting out there for a while right now.
Interesting. And what about on the vacation rental property management side of things? Given the saturation and where the market's at and everything we've discussed, is your strategy to try to continue growing that and adding management contracts, or more so maybe stabilize and focus on improving what you've got already rather than adding more properties? How do you see the property management side play into your goals for the coming years and months?
Yeah, we're ready to start growing again. We've been in a growth stage now for about 6 months or so. Back in 2023 and 2024, really the second half of 2023, and then kind of the first half of 2024, we were just really making an effort to stabilize the company. We grew so quickly there that every time that you grow and you go from 2 houses to 10 houses to 20 houses to 45 houses, you have to continuously reinvent the company in terms of how you do operations, how you clean the houses, how you do the laundry, how you service the houses, how you do sales. All these different things have to continuously be reinvented every time you double the size of the company, um, or even more often than that. And so we got to a point where we had a lot of overhead in terms of employees, salary employees. We had a massive real estate portfolio that we were managing, around a $70 million portfolio, 50 different pools, 30 different hot tubs, 70 different single family homes. And that came with all that oversaturation. Our portfolio was a microcosm of the more macro market, which was just being bombarded with short-term rentals. We actually invited, to your point, Sebastian, the downsizing of the portfolio for a period of time, just to let our investors get to a more healthy type of investment, whether that's we move them to a long-term rental structure where we got a 12-month renter in there and didn't have those peaks and valleys of the high and low season, or whether we just let people leave the portfolio as a whole. Some people sold, whatever that was. So we did kind of have about a 25% downsizing of the portfolio, and now we're back into a growth stage. Now, obviously, with where the rates are at, we're not getting as many sales calls as we once were when the rates are at 2.75%. We're getting 3 or 4 calls a day. Right now, we're probably getting maybe 3 or 4 calls, a week, maybe two calls a week, something like that, and 1 or 2 inbound leads from the internet. And a lot of those are people that are kind of more exploratory. They're not necessarily, they don't have a property, or they're not an escrow on a property. The market has slowed down a lot, to our previous conversation. And so we will continue to grow the portfolio over time. We're not in any rush. We'll take on the right properties, and we're going to do things kind of organically and grassroots, as we always have. We don't invest a ton of money into marketing or things like that. But a lot of referrals, and we get a lot of reviews on Google, and have some inbound calls and leads through there. But I wouldn't be surprised if we add maybe 10 to 15 homes this year, and maybe in 2026, another 20 homes or so like that. But we are wanting to grow, and hopefully we will.
Love it. Well, Rodney, this has been great. Thank you so much for taking the time and sharing so many insights, so many lessons. Super, super valuable. I took a lot of notes as well. Hopefully the audience did as well. So yeah, thanks for taking the time. This was great.
Yeah, thanks a lot, Sebastian. I appreciate you having me on. Thank you.
Have a good one. Take care. Bye-bye.
Thank you.